Well, hello everyone. It's Ben Kingsley here, the Chair of the Property Investors Council of Australia. Can you all hear me? Give me a little wave, say hi. If you can hear me okay. We're just getting started. We've got attendees arriving at the moment, so we are waiting for maybe 1 or 2 minutes. But in that time, I'm going to make sure that we've got our two very, very special guests with us here. So, Tim, if you can hear us, unmute for us, please, and say g'day. And then, Peter, if you can hear us also, please say g'day.
Hey, Ben, g'day. It's Tim Lawless.
Fantastic. And Peter, unmute and say g'day. Okay, so we're waiting for Peter. That's good because Peter comes in later tonight anyway. So is he unmuted? There we go. Pete, can you say g'day to us? Okay, so we've got to work on getting Peter back online, but that's all right. We don't need Peter until later in the show. So firstly, thank you all very, very much for coming. We are definitely recording tonight's session, so we can make sure that all of our 2,500 and growing members will be able to get this and educate themselves in regards to negative gearing. But also, you know, what's thrilling for me is being able to listen to Tim Lawless, one of Australia's leading property experts, to give us.
Hello.
Oh, there's Peter. G'day, Peter.
Hello.
Welcome aboard. We've got you, which is great. So you can now sit back, have a coffee, or in South Australia there you can have a nice red. Maybe from the Coonawarra region is probably where I would go. But thank you very much for your attendance tonight. So let's get started. We're a couple of minutes in, but you know, those people who are joining us now will be able to pick up. So I want to talk about what's on tonight's agenda. Firstly, we're talking about, if I can just get the slide deck to move. No slide deck, or I have to click back here. There we go. So we're going to get a market update from Tim Lawless. So I just want to introduce you to Tim. Tim is one of Australia's leading residential property market commentators on real estate markets and demographic trends. As the founder of the Corelogic Australian Research Division, formerly RP Data, Tim's expertise across property markets has positioned him as one of the country's most experienced and popular property market analysts and commentators. As Group Research Director, Tim leads a team of analysts across both Australia and New Zealand and is responsible for reporting on property market conditions and the interplay with the economics and demographic factors. Good evening, Tim.
Ben, good evening. Thanks for having me along to your webinar tonight.
Fantastic. And I'll also take this opportunity to introduce you to Peter Koulizos. Peter Koulizos is a lecturer and tutor at University of South Australia, coordinator of property and share investments at TAFE SA. Peter holds a master's degree in business property and a master's of urban and regional planning. Peter is currently research focused on gentrification and residential property markets. Peter is researching indicators which may, at a predictive precursors identifying gentrification in areas. Peter also conducts research in Australia residential property markets, and we're going to be sharing some of Peter's research tonight as well. So thank you, Peter, for joining us. Okay, we'll move right on. So next on the agenda, we're going to debunk Labor's policy. So there's a lot of myth and commentary out there at the moment, so we're going to take a deep dive into that, and then we're going to go into the Q&A session with Peter, and Tim has kindly said that he'll hang around, and then myself. Now, there is a lot of information in this slide deck tonight, so both in terms of the data side for Tim, but also in the commentary that we have inside the slide deck in regards to Labor's policy. A couple of things on that. So we are definitely going to be sharing the PICA's slide deck. In terms of Corelogic, we'll come back for that at a later time. But in terms of the information in regards to Labor's policy, we will be sharing to all of our members. So we thank you all for coming, and we'll make sure we get that out to our valued members. So without further ado, I'm going to move on to our first slide and get Tim to take over as host so he can move the slide deck. No, I'll have to move the slides, Tim, I suspect, when you tell me to.
Sure, I'll just scratch my head, okay?
Yeah, sounds good.
Thanks, Ben, for inviting me along. Just for a little bit of context, Corelogic and PICA have had a long relationship, really since its inception. But I've known Ben a lot longer, of course, through his professional endeavours, and also have a long history with Peter Koulizos as well. So it's great to be involved with something that Peter is as well. And I'm looking forward to what Peter has to say also. So with that, Ben, if you don't mind forwarding to the first chart on slide 3, I thought I'd start, rather than getting straight into what's happening with housing values and the market broadly, I thought I'd start with turnover, because this really tells the story about what's happening in the housing market at the moment. So the first graph I've got here, and by the way, everybody listening, my presentation's a little bit graph heavy, so I apologize for that in advance. If you're not used to looking at graphs, sorry. Okay, but anyway, what's happening with transactional volume really tells the story in Australian housing. The graph I've got here looks at month-to-month settled sales nationally with a 6-month trend through that monthly activity. And you can see a couple things from this graph. The first is that over the most recent housing cycle, we haven't seen transactional activity get anywhere near as high as what it was over previous upswings. And that's despite the fact that, of course, we built a lot more housing since, say, 2004. So one of the big reasons why we haven't seen as much activity in the housing market over the most recent decade is that the growth phase we've just been through has been very top heavy, in the sense that it's largely been a factor of Sydney and Melbourne driving the strong market activity and rates of capital gain. Most other markets have been relatively subdued, or maybe a better way to describe them is we've been seeing values tracking very sustainably. But of course, around about early 2015, we did see the first of a whole bunch of different policies impact on activity across the market. And of course, I'm talking about the macro-prudential policies. The first one was a 10% speed limit on investment credit. That kicked off in early 2015. And you can see from this graph that pretty much coincides with the peak in transactional activity nationally as well. In early 2017, we saw the second round of macro-prudential. There was a 30% origination limit on investment lending, on interest-only lending. And then through 2018, we saw the impact of the Royal Commission, tighter serviceability assessments, a lot more scrutiny around incomes and expenses. And of course, most borrowers couldn't borrow as much as they could have a few years ago. So we have seen the impact of all those different financial or credit policies impacting on the market. And that's the big difference with this housing market at the moment, is that previous housing downturns have been very much either economic-led or have been affected by monetary policy, interest rates rising or falling, or by a global economic shock like what we saw in 2008. This downturn is very much the factor of tightening credit. Okay, so quite different from previous periods. Let's move on to the next slide, Ben, and let's start talking about housing values. And this is probably where most people are the most interested, is what's happening with housing values around the country, particularly in the area that's either you're investing in or you're thinking about investing in, or that you already own properties. So the couple of graphs I've got here are looking at the rolling annual change in values for housing across each of the capital cities. The largest capital cities on the left and the smaller capital cities on the right. So there's a few trends you can see here. The first is that, well, for starters, Sydney and Melbourne are really leading this downturn, but they also led the upswing. The 5 years prior to both these markets peaking, we saw values rising somewhere between 60 and 70%, depending on which city you're in or looking at. And also, since those markets peaked, well, Sydney was in July 2017 and Melbourne was in November 2017, we've seen a fairly rapid rate of decline. In fact, Sydney values are down about 15%, nearly 15%, and Melbourne values are down a little bit more than 11% since those markets peaked. Okay, but the other thing you can see here is that outside of Sydney and Melbourne, every other capital city market is losing momentum. We're still seeing Perth and Darwin drifting lower in terms of annual value growth or value change. We've seen Brisbane, Adelaide lose some momentum as well. Both those markets had very sustainable growth rates through the growth phase and really don't have any affordability challenges, at least in relativity to Sydney and Melbourne. And even markets that have been very buoyant, Hobart and Canberra are probably the two best examples, have also seen momentum leaving those markets. The common denominator across all these markets doesn't come back to economic conditions or demographic conditions. It comes back to the fact that credit has tightened quite substantially across the board. Okay, more so for people who have high debt levels, absolutely. But generally speaking, if you're an investor, you're typically paying about a 55 basis point premium higher than an owner-occupier. And if you're not paying down your principal and you're an investor, then that mortgage rate premium is going to be quite a bit more substantial, could be up around 100 basis points, which clearly is quite a disincentive across the board. And also owner-occupiers are finding it harder to obtain credit as well. I'll touch on those credit flows a bit later on. Let's go to the next slide, Ben. So while that seems really quite negative and gloomy, it is, by the way, it's that the market is in a fairly broad-based downturn. We are seeing a few hints that maybe we're through the worst of it. Okay, if you look at our indices on a month-to-month basis, which is what I plotted out here for the largest cities, you can see that since December/January, the month-on-month rate of decline has been consistently improving in Sydney and Melbourne. Remember, these are the two cities that have been driving the downturn. The monthly downturn in Brisbane has been very mild. It just touched back a notch in April. And we've also seen the rate of decline in Perth starting to moderate a little bit as well after re-accelerating on the back of those tighter credit conditions through the second half of 2018. So that's a pretty good indication that potentially we're through the worst of it. But of course, Sydney and Melbourne are still seeing values falling at about 0.7 to 0.6% month on month at the moment, which I certainly wouldn't describe as strong conditions. In fact, values are still falling reasonably rapidly, just not as bad as what they were previously. And it's our expectation that we probably will see a continuation in this moderating trend as value declines continue to ease off, particularly if we do see rates coming down, which is what we're expecting later this year. Let's go to the next slide. So I've talked a lot about the downturn in certain cities. This graph looks at each of the four capital cities where the downturn is quite entrenched, right? You've got Sydney and Melbourne, where they're in a fairly fresh downturn, and Perth and Darwin, where values have been falling since 2014. And the reason I chose to show you this graph is really to highlight the differences in these four cities, or really these two different trends. On one hand, you've got Perth and Darwin, where the downturn is very much an economic downturn. It was led by a peak in the mining boom, a downturn in the big infrastructure spending activity, which resulted in higher unemployment and lower jobs growth, an exodus of migration to other states. So we saw housing demand pull back. Whereas in Sydney and Melbourne, this housing downturn is happening at a time when unemployment is virtually at record lows, down around the low 4% mark for both Sydney and Melbourne. Jobs growth is very strong. The state economies are generally very strong. Migration remains high from overseas and interstate into Victoria. So that's the big difference between these markets, is that Sydney and Melbourne are in quite a steep downturn at a time when the economy is actually quite strong and mortgage rates are the lowest they've been since the 1960s. Really highlights how different it is this time around. Let's go to the next slide, Ben. So I know we focus on the capital cities a lot. I thought I'd just have at least one slide that I did focus on the regional markets around the country. And I thought I'd get bang for buck and include every single regional market nationally on this one slide. So the way to read this particular graph, well, two graphs, is on the left-hand side, we've got regions around the country where values have fallen over the past 12 months. And I've got two sets of numbers on each of these graphs. The hollow bars, your annual rate of change over the last 5 years. That gives you a bit of an idea of what the normal rate of movement in values has been over or since 2014. The blue bars represent what's happened over the past 12 months in values. So you can see on that left-hand side, most markets have lost quite a bit of momentum. Generally, the 5-year annual rate of growth has been in positive territory. Whereas on the right-hand side, it's all the markets where values have risen over the past 12 months. You can see there are still quite a few of them around the country. The areas that are still seeing values rising tend to be either around regional Tasmania, or they're around regional Victoria in the areas adjacent to Melbourne. There's a really interesting juxtaposition here where we are seeing the areas around Melbourne, I'm talking about Ballarat, Bendigo, Geelong, Latrobe, are generally still seeing some level of capital gain. Okay, Geelong's just starting to slip into negative annual growth, but has been quite resilient. Whereas the same sort of cities around Sydney are actually some of the weakest markets in the country. You can see that around the bottom of the graph on the left. You've got areas like Illawarra, that's Wollongong, Newcastle and Lake Macquarie, the Southern Highlands, where values have fallen by at least 7% over the past 12 months, really following the trajectory of Sydney. I think a big reason for that resilience in Melbourne's satellite cities or major urban centres comes back to the very strong interstate migration growth we're seeing across Victoria, as well as the fact that most of those satellite cities are still very affordable. You don't have those same trends across those same regions in New South Wales. You can also see there are a few lifestyle markets on the strong list, on the better performing list. We've generally seen lifestyle markets outperforming the broader market. We've got an aging population. Baby boomers are certainly cashing out and looking to leverage their equity. But overall, most of the markets around the country, be it capital city or regional, are seeing pretty tough conditions. So if you are investing, or if you have plans to invest, just joining the queue and buying somewhere without a great deal of research or a great deal of strategy doesn't work too well anymore. You really have to be quite smart about where you're investing. And in some cases, you simply just can't ride a wave of capital gain. You really do need to create your own value growth, either through buying well below the market or through renovating or adding value, that type of thing. It's quite tough just to passively grow the value of your property at the moment. Okay, let's go to the next slide. I know we talk a lot about our indices, and that's certainly the best way to measure value growth over time, but median values certainly do still have a place in our analysis, and that's what I'm looking at here. I just wanted to lead into an affordability discussion, and this is a good place to start. So we've seen Sydney values, for example, peak out for houses just a little bit over $1 million. They're now down to about $880,000. So we've seen the typical house owner lose maybe around about $150,000, $160,000 in their overall wealth if they own a house in Sydney. Right. Another really interesting point you can see from this graph is there's somewhere like Perth was way back in 2006, 2007 was the most expensive city to be buying into in Australia. Okay, it was even more expensive in that market than it was in Sydney. Okay, you can see that over time, as Perth has moved through a downturn and most other markets have actually seen value growth, Perth is now amongst the most affordable cities to be buying into nationally. Okay, that's, I guess, the silver lining around this downturn is that housing affordability in some markets, like Perth and Darwin are the best examples, have improved materially. Unit values, there's not as much difference between the markets, but clearly you can still see that there's always going to be a premium in some markets. Even though prices have come down in Sydney and Melbourne, values are still generally quite high relative to the other capital cities. Okay, let's move to the next slide, Ben. So that leads us on to affordability. And the best way to measure affordability is through a dwelling price to income ratio. Okay, this ratio simply measures the pace of income growth or household income growth relative to dwelling values over time. At the moment, even though we have seen values falling in Sydney and Melbourne, we're still seeing relatively high ratios of incomes to housing prices. Whereas in markets where values have fallen or where income growth has been stronger, okay, Canberra is a really good example of where income growth has been a bit stronger than other markets. We have seen the dwelling price to income ratio actually either improving or holding quite firm. So you can see there are plenty of markets around the country where, based on this ratio, it's actually more affordable to buy a home now, at least relative to incomes, than it was 10 years ago. Whereas in the very expensive markets where values have risen quite quickly, that certainly isn't the case. Okay, if we're to talk about mortgage serviceability, that's very different. Okay, if we're looking at how much income a household would typically need to dedicate to servicing a mortgage, that's actually fallen quite substantially, and it's well below where it was 10 years ago across every capital city, simply because mortgage rates are as low as what they are. So I think the lesson here is getting your foot in the door of the housing market, raising a 20% deposit or raising any deposit, justifying your expenses and your incomes to your lender as a borrower is generally the hardest part of the moment. But servicing a loan is generally much more straightforward considering interest rates are where they are. Okay, next slide, please, Ben. Okay, let's move on to the next one. And I thought it was a good way to look at where the market's going from here is to start examining stock on market. So our listing numbers are really interesting. You can see there's two sets of numbers here. On the left, we have new listings being added to the market. And on the right, it's the total amount of stock being advertised for sale. To cut the long story short, we're seeing vendors very reluctant to sell in this marketplace. The black trend line on the left, which is the year to date for 2019, is much lower than any of those other trend lines, which is the prior calendar years, back to 2012. So we're seeing a lot fewer new listings being added to the market. But maybe counterintuitively is the fact that we are seeing total listings in the market way higher than what they have been over previous years. And this is just the result of less absorption in the market. The first slide, remember I talked about, was the fact that we've seen transactional activity slow around about 20% in Sydney and Melbourne, a little bit more than 14% nationally. Homes are taking longer to sell. There's a lot of stock to choose from. Buyers have a lot of negotiation ability in this sort of market. If they don't get the price that they're looking for, that suits their budget and their lifestyle, they can simply move on to the next property and drive an even harder bargain. So a good time to be a buyer, but not a great time to be a vendor in this sort of market. Next slide, Ben. So the consequence of more stock on the market is that homes are taking longer to sell. Okay, nationally, it's about 52 days across the combined capital cities. When the market was racing along, it was about 29 days. Okay, in Sydney, it's 60 days. Melbourne's about 40 days. Brisbane, about 60 days. So you can see every market around the country has seen a bit of a blowout in transactional timing. Hobart, that's the best example. A year ago, homes were selling in Hobart in 9 days, and now it's taking a little bit over a month, right? So if you wanted an example of FOMO, the fear of missing out, that really drove Sydney and Melbourne for some time there in 2015, Hobart's just been through it. Okay, there was a lot of urgency in that marketplace for some time, but that's now starting to dissipate. The next slide shows vendor discounting. Very similarly, we see vendor discounting is how much negotiation you have in the market. That's blowing out in most other capital cities as well. So the result of these two graphs really highlights that as a buyer, you do have a lot of negotiation power. There's no urgency in this market. And there's a lot of stock to choose from, which means you're in the driver's seat as a buyer. The next slide shows auction clearance rates. And you can see the clearance rates across Sydney, for starters, have really started to improve. From a low base, I'd have to say. So we've seen about a 30% reduction in auction volumes. But since December last year, we've seen the clearance rate in Sydney move from being just a little bit below 40% to hold around that low to mid 50% range. And as I've demonstrated in the graph on the right, the correlation or the fit between value growth and auction clearance rates is still very strong. So this bounce back in clearance rates has been accompanied by an improvement in the rate of decline across the Sydney marketplace. So it's still a very good timely indicator. The reason I'm focusing on Sydney and Melbourne for auction clearance rates, by the way, is that these are the two cities where auctions really matter. We still see a large proportion of properties being taken to auction in these markets, whereas most other markets around the country have very low proportions of properties actually being taken to auction. Perth, for example, it's only about 5% of properties will be taken to auction. The rest will be private treaty. A little bit higher than that in most other cities, but Sydney and Melbourne are the most relevant for auction clearance rates. You can see Melbourne's showing a very similar trend to what Sydney is. Okay, let's move on to the next slide, please, Ben. And we'll change tack a little bit and look at rents and yields. Okay, so rents and yields, I think, will become a much bigger part of the investment equation if we do see a change of government. I know Ben and Peter will be going through some of the implications of a change of government a bit later on. But at the moment, so I suppose the recent history has been that rental yields and rents have probably been a secondary consideration for a lot of investors, simply because you do have the benefits of negative gearing, and the main game has always been capital gains tax. Okay, so what we're seeing at the moment is that yields are generally improving, but on the back of fairly sluggish rental conditions. You can see the annual change in weekly rents here is typically pretty low for every capital city. Perth is the one exception where rents are accelerating. Okay, you can see Perth has been through a very long period of underbuilding now, as our market's been going through a downturn, and rental supply is very short. Occupancy rates are very high. But most other markets have seen an influx of rental stock on the back of a lot of investment. And also some markets where first home buyers have really picked up have taken away from rental demand as well. So on the next slide, you can see the consequence of falling values together with rents generally rising is that rental yields are improving. A really good sign for the marketplace. And it does imply that if you are buying into the marketplace as an investor and you are starting to look for higher yielding markets that also have prospects for capital gains, we're starting to see more and more areas that are fitting that profile. Okay, the highest yielding market is still Darwin. Okay, rental yields in Darwin up around the 6% mark. That's still not high enough to be attracting people in that market because we're still seeing values falling in that market. In fact, the only reason rents or yields are rising in Darwin is simply the fact that rental values are falling at a lower rate than housing values in that market. Okay, but most markets seeing an improvement in rental yields. Okay, next slide, please, Ben. Let's touch on housing supply really quickly. I wanted to touch on housing supply with a bit of a focus on apartment supply, particularly off the plan, because we are seeing some risk in that particular sector. You can see the graph on the left looks at how many apartments and houses are under construction nationally at any point in time with this data up to the end of December. Okay, there has been a real unprecedented rise in apartment supply nationally, with most of that, as you can see the graph on the right, most of that apartment supply very much concentrated in New South Wales and Victoria. Okay, it looks like my legend on my graph has been shortened a little bit. Sorry about that, guys. That's my fault. Okay, you can see outside of New South Wales, Vic and Queensland, I've also got South Australia and WA in the green and the blue on this graph as well. So one way to look at this would be that New South Wales and Victoria still have a very high amount of unit supply that's being built that'll be flowing into the marketplace between now and the next, say, 18 to 24 months, which does imply some risk, particularly for those people who purchased off the plan around the peak of the market. So if you look at some of those distress indicators on the next slide, we can see that our valuation data, this is data that's proprietary to Corelogic from our Valix platforms. It highlights that at the time of valuation for off-the-plan apartment settlements, we're seeing a fairly rapid rise in undervaluation events in Sydney and Melbourne. Brisbane's already been through that. Okay, Brisbane's apartment supply peaked out more than 2 years ago. So this market's only now just emerging from the hangover of oversupply in the new apartment sector, whereas Sydney and Melbourne are really quite early in that phase. So I'd probably offer up a little bit of caution in buying into that new investment grade high-rise apartment market. I don't think apartment markets are off the cards by any means. I think there are some really good opportunities out there for higher quality stock that's probably not purely slanted towards the investment markets, and in areas where we haven't seen precincts with a massive influx of new supply. Okay, there's still clearly opportunities out there to be buying into the apartment market. I'll just be using a bit of caution around the high-rise investment grade market in Sydney and Melbourne. Next one. Okay, even though we have seen supply really ramp up, dwelling approvals are clearly ramping down. Okay, this is a clear response to some of the supply concerns around the apartment markets in most markets, but also just the weaker housing market conditions and the tighter level of housing finance or development finance as well. So all the major markets are seeing less approvals. Overall, this could be seen as a negative for the economy because property construction is a big part of our economic growth. But it could also be seen as a positive because less supply coming into the marketplace at a time when there are some supply concerns is actually very healthy. So it's good to see the marketplace is adjusting to these high supply levels. Next slide. Thanks, Ben. Okay, I thought I'd touch just really quickly on how much supply is being introduced by the public sector versus the private sector. By those two sectors, I simply mean the private sector is, average everyday Australians, people like you guys and myself, not government entities, are generally responsible for building about 99% of Australia's housing stock. Okay, you can see the public sector, which is the government, There was a little bit of a blip upwards in 2009 as part of the post-GFC stimulus. But overall, we've generally been seeing public dwelling approvals and construction activity around housing has been very low for a long time, but it's been trending even lower, right? So certainly not a great indictment for the government around improving housing affordability by introducing or doing their bit to introduce new housing supply, be it affordable housing or community housing. Both ways, not a great look for the public sector. Okay, let's move on. I wanted to touch really briefly on the demand side. That was the supply side really quickly. But the demand side of housing generally remains relatively strong. You can see, I know there's a lot of lines, trend lines on this page. All I'm looking at here is the different components of population growth. And remember, population growth is really a good indicator for, or a good proxy for housing demand. The more people coming into an area, the more people need a roof over their heads. So if you look at the bottom set of graphs, that's the overall net quarterly rate of population growth or population change. And you can see in New South Wales, Victoria, and Queensland, generally population growth is still very strong. And finally, in South Australia and Western Australia, where there has been quite an ongoing downturn in population growth, it's really turned a corner. We're starting to see interstate migration really picking up in those markets from a very low base, albeit, but certainly an improvement from where it was previously. Overseas migration still generally remains very high across the three largest states, holding pretty firm now in South Australia and Western Australia, but clearly quite a bit lower than where it was at the peaks. Okay, let's move on to credit before I finish off, guys. As I mentioned in the first slide, credit is really what's driving this market downturn, credit availability. There's a couple sets of numbers here I wanted to focus on a little bit, mostly because they really explain the macro-prudential policies that I was talking about on the first slide. So the graph on the top right-hand corner, which tracks the annual change in owner-occupier and investor credit, really highlights how strong investment credit growth was during the boom up until about 2015. Investors were really outpacing owner-occupiers in the market, but as we saw all these credit controls and policy constraints coming in around early 2015, we can see that credit growth for investment purposes has slowed remarkably. In fact, the last few months has been virtually zero, and over the past 12 months, we've only seen investor credit growth increase by a little bit less than 1%. That's a record low, by the way. We've also seen interest-only lending more than half from where it used to be. That's the graph on the left-hand side. The reason we saw interest-only lending curbs introduced to the marketplace was that we were seeing more and more owner-occupiers taking on these sort of loans at a time when household debt was at record highs nationally. So at the moment, we're seeing interest-only lending remaining very low. I don't think it's going to pick up anytime soon, by the way, because I don't think we'll see any sort of differences in mortgage rates. Remember, if you're not paying down your principal, even if you're an owner-occupier or an investor, you're generally paying a very stiff premium on your mortgage rates. So if you're an investor who's not paying down your principal, you're probably paying about 100 basis points more on average than an owner-occupier that is paying down the principal. So a big difference. The final set of numbers there on the bottom right was, thanks Ben, was just highlighting how important it is to have a deposit these days. Only about 20% of the market in the December quarter had a deposit of less than 20% when they received their loan. So really highlighting how much focus there is on your savings and having a deposit in the market. Okay, the next slide looks at credit growth between owner-occupiers and investors. This really highlights, a couple things. The slowdown in investment numbers, that's the blue trend line on the bottom there. Okay, we saw investment in the Australian housing market peak at $9.4 billion in early 2015, just as we saw the introduction of those macro-prudential policy levers. Now, at the end of February, that is reduced down to 4.7 billion, so virtually halved. But of course, I think what's more indicative of the weaker market conditions most recently is this slowdown in owner-occupier credit, which over the second half of 2018 and into 2019, we've seen a very sharp slowdown in owner-occupier lending, which is, I think you can probably tie a very close relationship there between the Royal Commission and the tightening lending standards and how much owner-occupier credit growth has been in the market. Okay, an early sign that maybe that's starting to open up a little bit in February. Remember, these numbers are seasonally adjusted, so there has been a bit of a tick upwards in Feb. And our own data, our valuation data at Corelogic, suggests that we probably will see another tick up in March. So 2 further hints there that maybe we've moved through the worst of it and starting to see credit issuance moving upwards from a fairly low base. Next graph, Ben. Finally, investment numbers across the states. Interestingly enough, if you look at the graph along the bottom here, which looks at how much investment there is in each state as a proportion of all lending, investment is still concentrated in New South Wales, which is a bit of a conundrum for me. You know, when you look at a market that's low yielding, has fairly dim prospects for capital gains, has been through quite a dramatic upswing in values, we're still seeing about 1/3 of mortgage demand in New South Wales is investment related. Personally, I would have thought there's some brighter pastures to be investing in. You know, Southeast Queensland would be one, South Australia, maybe starting to pick the bottom of the market in Perth. Tassie has also been on a pretty decent upswing as well, although showing a few cracks now. So interesting to see how much we are still seeing investment concentrated in markets that are generally quite weak. Okay, next slide. I'm nearly done, guys. I know I've gone a bit over time, Ben. Sorry about that. I just wanted to touch on first home buyers. You know, this is the flip side, and this is where first home buyers have really reacted to stimulus in the market. If you look at the proportion of first home buyers in New South Wales and Victoria, that's the black trend line, and the blue trend line in the graph on the left, you can see there's been a dramatic upswing in first home buyer activity, right in line with stamp duty concessions that were introduced in July 2017. So for a lot of buyers in those markets, you can save $30,000 as a first home buyer on your stamp duty if you're buying under certain thresholds, under $650,000 in New South Wales and $600,000 in Vic. So that's probably the main reason why we've seen an uptick in first home buyer activity. But of course, other people would argue that there's less competition with investors. There's a lot of stock out there, so it's good buying conditions, and the fact that values have come down have improved affordability as well. So that's probably one of the reasons why in WA, first home buyers are such a large proportion of the market, is the fact that values have come down and things are now quite a lot more affordable. Okay, I think there's one more slide. We've got mortgage rates. Where to from here for mortgage rates? Well, probably downwards. You know, the rate cut or the monetary policy decision from the RBA this week was probably a 50-50, and a lot of economists were calling a rate cut to be had. My guess is the next couple of months could be a live decision from the Reserve Bank. The big question is how much of that gets passed on to mortgage rates. I think a lot of it will be, not all of it, but most of it, simply because the banks are so competitive and funding costs have come down as well. So there's no reason for those lower cash rate not to be passed on to mortgage rates, at least to some extent. Final slide, Ben. I think we've got a summary. Yep, there we go. Okay, so guys, I think the key thing to watch going forward is going to be credit availability. As I've been harping on about, this downturn is really about credit, and it's tightening, not really about economic conditions or demographic conditions or anything like that. Okay, low mortgage rates, high population growth, the improvement in affordability are all things helping to keep a floor under housing prices and stave off some of that impact from the very tight credit conditions that we're seeing. Of course, there are some mortgage rate premiums for investment. Okay, you saw that on the previous slide. And also yields are relatively weak. I'd caution around the high-rise apartment market. And of course, a few wild cards in the wings. We've got the federal election just around the corner, potentially some changes to negative gearing and capital gains tax concessions, which overall would likely have a dampening effect on investment activity in the marketplace. Hey, I'll wrap it there. Sorry to go over time a little bit, Ben and Co, but yeah, hopefully you found that interesting.
Hey guys, and Tim, thank you very much. I don't think anyone's complaining about going over time. Can we have a show of hands there in terms of who got a lot of benefit out of that? That's why Tim is one of my go-to people when I've got some questions about the data that I'm looking at to see whether, you know, he gets his insights and reading the play as much as I'm reading the play, and we're aligned, because if I'm not aligned with Tim, I've got to go back and have a look at some more data. That's the truth. So, Tim, we greatly appreciate that time. Now, there was a good question that came through from David, so I'm going against our flow here, but I just want to get one question. And if anyone's got any other questions, you've got the Q&A box to put your questions in. We are doing Q&A at the end of tonight's webinar, but I thought this was a pretty good question here from David. It says, "Hi Tim, have you seen a trend in interest-only loans not being converted to P&I due to serviceability?" There was a lot of murmurings in the market, Tim, probably 18 months ago, talking about, you know, what was going to be the catalyst for the property bubble, and everyone was saying, oh, people won't be able to refinance their interest-only loans. Obviously, there's definitely people in that boat, but have you noticed a significant amount of numbers coming through your data, Tim, to make you concerned about that?
It's really interesting. Great question, by the way. It's really topical. We haven't seen any evidence of this interest-only cliff that a lot of analysts have been referring to is impacting on the market. In fact, it's the opposite. We're seeing evidence that a lot more interest-only borrowers are transitioning early, simply to take advantage of the lower interest rates that are available if you are paying down your principal. So absolutely, as you say, Ben, there are going to be some isolated examples where there has been some distress, where people haven't allowed for their interest-only period to expire, and then they'll go into a P&I. But I think for the large part of the marketplace, it's been managed and transitioned very well. I know lenders have been communicating this very, very clearly and loudly to their borrowers. But it does seem to be the trend is the opposite, that most borrowers who can are transitioning early, because you can really take advantage of the very low mortgage rates if you do so.
I think you're 100% again, Tim. I was of the same belief. It was almost impossible to find concentrations around marketplaces where there would be enough of that rollover at exactly the same time that would have put any distressed property markets in play. And so I agree with you. I think it's definitely slowed people's buying activity down. From an investor's point of view, I think it's going to take longer to accumulate a portfolio of property, but that's been the read. And so I certainly didn't buy into any interest-only cliff or rollover cliff. So great question, David. Thank you very much for that. Now, Tim's going to hang around. We do have a lot of content to get through, so we may go a little bit over time. Please understand that this is a very important conversation that we're having in regards to the market. And whilst I'm introing that, I'll just go to Tim's. Sorry, I've just got to get back onto the page, and there's the disclaimer from our good friends at Corelogic RP Data. I also wanted to just highlight to people, you are very privileged. Tim does presentations to businesses and industry on a regular basis, as does Cameron Cusher. But to have the expertise and the level of expertise of those two people showcasing the level of data that we've got available to us through Corelogic. So I do say to you that if you are research driven, which you should be, that there are some products that Corelogic do offer direct to consumers. And over time, we'll have a bit of a chat with Corelogic potentially around getting some offerings to our members as well. So, thank you very much for that, Tim, and we'll look forward to chatting with you in the not too distant future in Q&A session tonight. All right, so in terms of debunking the policy, there's a couple of things we're going to be sort of working through pretty quickly. And again, I think you might find that you might be drinking from a fire hydrant at the end of this, because there is a lot of nuances. There are a lot of moving parts when it comes to the property market. It's fundamental to our broader economy. There's around $6.3 trillion worth of value. So it's incredibly important to our broader economy, both through direct and indirect economic activity. Now, so I want to just take a moment to profile the property market, then look a little bit at the history of the negative gearing policy, and then sort of try and read into where we think the changes and the impacts of those changes will be, and then start to look at what we can do potentially as an association to try and ensure that Labor potentially sees the errors of their way. For those of you who do follow me, you know I'm very public in this area, and as the chair of the association, I'm going to do everything to protect the interest of investors, but also in this particular case, potentially the interests of all property owners in the country. So let's have a quick look at the investor profile of Australians. So there's 2.2 million property investors out in the marketplace. We have around 2.7 million investment property. So going back to that slide that Tim was talking about 1% of the stock is being generated, the new stock is being generated by government, and 99% of that stock is basically being generated by new owners and also investors buying that new dwelling stock that's coming online. So we do a lot of the heavy lifting in terms of providing great rental accommodation right across Australia, for whether it be new arrivals, people intermittent and interstate jobs, trying new areas, moving house, and so forth. So, that sometimes gets lost in the media rhetoric. So overall, there's around 10.1 million properties in the marketplace, and that really does affect 18 million people, both including owner-occupiers, investors, and also the renters that are housed in the accommodation of that 10.1 million. And that's growing at around that sort of 150,000, and you saw there from Tim's data, that sort of long-term average growing at around 150, 160. That peaked up at around 230, and there's still a fair bit of, as you saw, there's some unit stock that's going to come into play in the next 12 or 18 months, so that's also important to note. Now, the ATO does a great job in providing us with some insights in regards to the people who are investing in property, and the latest data, which is the 16-17 data, so it does take a while for them to release this, because in reality a lot of people take their time in doing their tax returns, so they do wait that extra period to get the data as reliable as they can. And you can see there, since 2016-17, there was an increase from the previous year of 41,000 people who bought their first investment property, 12,000 who bought their second, 3,000 who bought their third, 1,200 who bought their fourth, 641 people who bought their fifth, and obviously 6 or more. Now, also remembering this for those of you who are new to understanding data, that is transitioning, because there are people who are selling properties as well. So there's new people coming in, there's people who are selling down, so that's also to be understood. So I did take a little bit of interest in regards to, you can see there 5 properties per population. That quite hasn't lined up there, but you can see the people who own 5 properties in the broader population is 0.077 of 1%, and 6 or more properties you can see there is 0.08 of 1%. And you can see those ownership splits just under 71%, 18%, etc., etc. So not a big amount of people have that. And I think under this new credit regime that we have, I think gone are the days where people are going to accumulate large portfolios quickly. They just simply won't be able to get the finance. If we move into the second set of information here, I thought this was also quite interesting to show. So this is the information that the tax office produces in terms of net rental losses. So you can see here, of those properties, the individuals, these are the people who are negatively geared. And that's the big topic for tonight. So 1.3 million people have got negatively geared properties. And you can see there's 855,000 people whose properties are now neutral or positively geared, and they're starting to pay tax on those properties. So they were able to claim the expenses, and these people are still claiming more expenses than the income that they're earning during that period, and obviously rounds out to that. Now, you heard me say 2.2 million property investors, because we're effectively 2 years past that point, and that's where I took that number from, in terms of approximations of how many property investors there would be in Australia at the moment. Now, I want to then pivot to have a look at lessons that we may be able to take away from the original introduction of negative gearing the abolishment of negative gearing in 1985 to 1987. Now, negative gearing, or the ability to claim the expenses against the income that you're trying to earn, has been in our tax system from my records in reading from around the early 1930s, that you were able to do that on property. So one of the first bits of information we need to understand, I think there's a nice segue into some of the myths that are going out there. But overall, we saw that SQM Research went back and had a look at the construction data, and they found that there was, during that period, a 27% fall in construction that occurred over that time. Now, back in that day, it was a clear abolishment. There wasn't any new versus old, and we'll get into what the new proposed policy is for Labor in a moment. But I thought it would also be really interesting to run the analysis. And so I grabbed some data from the REIA, got the team on it, and we started to look at, because there's been some great debates from people like Lawless and people like Grattan Institute, who were sort of saying, they're arguing rents didn't go up, they did go up. No one was really definitive on their position there, and even the ABC fact check sort of went with some more broader data. But I think it's really important to try and isolate this. So we're going to spend a minute on this to just explain what's going on. So here's the period where September through to, July of 87 through to pretty much 85 to June of 87. I'll get that right in a minute. So in Sydney, for 3-bedroom houses, and this is the stock that's not coming online quickly. So units can come online a little bit quicker, but you can see here, this is also then the vacancy rate. So you can see from a vacancy rate point of view, when the vacancy rate got under 1%, and that would be classed as a very tight rental market, we did see a severe increase in terms of rents inside that Sydney market. Now, after that period, one could assume that we did see a spike in investors coming into the market, which naturally led to accommodation being open for rental, and that accommodation was shown in the vacancy rate increasing, and that then quelled the increase in rents. Now, you know, Tim's just taken us through some great data that sort of does show once you go through a boom and a big lot of supply comes online, your yields do suffer, but they do improve over time. And there's two ways in which they improve. One is the valuations go down, but the other one is on the supply side. And I'm going to be focusing very much on demand and supply, because they are the ultimate levers that determine prices for both rent but also for property values. Over here, the second most severe market was the Perth market. And you can see here, again, we saw this very, very low vacancy rates level, so a very tight rental market, and that allows for demand to push up rents, okay? And then after that period, not saying that they boomed, but they did get back up to what we would call a balanced market, around that 2 to 3%. And you can see there that they flattened off. Okay, so the growth rate was only 13%, but still growing, but flattening off a little bit more. And I suspect if we looked at the data, if that vacancy rate went a little bit higher, you'd probably see rents flattening out or coming back down. Brisbane, we saw a 32% increase. Now, you can argue here that obviously vacancy rates were still quite high at that time, okay? But here's another clear indication that when the vacancy rates got down to that critical tightening area, and that seems to be the correlation here, when vacancy rates are getting to 1, we do see spikes in the rental being paid per week. So that's another trigger that evidences that. Obviously a balanced market. We didn't see that market absorb during that period, but we did see it absorb straight after. And investors must have come in, because it's the only way in which you can get vacancy rates, or people are buying properties, you know, and moving on. So that's another example of that. Now then we go to Melbourne, which only had, and if you think about this time, this was a reasonably higher inflation period in our lifetime. It wasn't the crazy 90s, but there was definitely inflation in the system, sort of 4 or 5% at that time, if my memory serves me correctly. So again, vacancy rates sitting pretty standard, a fair amount of available accommodation, so not so significant price growth in rents. So whatever happened in Melbourne at that time, there was enough accommodation to accommodate those people. But the big question would have been, what would have happened if that had continued to be sustained? Would that have tightened up? And if they did tighten up, then ultimately that's where you get that higher rental cost. Oh, have I jumped ahead now? The last couple, Adelaide, same sort of thing. We didn't really ever get to a critical tightening, and because we didn't get to that critical tightening, we didn't see pressure on rents. But in Canberra, there's an example of that critical tightening, and there's an example of probably some very strong growth from 120 to 140, so significant number. but supply coming in, interestingly, during that period. But you can also see here, again, when vacancy rates did go quite high, the rents flattened out. So that was adequate enough accommodation which didn't put pressure on rents. So if we think about it, wherever that construction was not implemented, meaning that decline in construction means that the supply isn't coming online. When that supply doesn't come online, we get pressure. When it does come online, we don't get pressure on rents. Now, what is interesting is that it was the Keating and Hawke government that did implement the negative gearing policy, and it was in August of 87, I should say, that Paul Keating, the then Treasurer, did go to the Cabinet in his submission and argue the point that the tax reform changes have now been in place for 2 years, which would appear to be the reasonable period for adjustment to have worked through so that investors may again return to the rental market. So that's an admission to say that whatever the reason was, it was very much about the supply side, that there wasn't supply coming through, the construction was slowing down, and when you do have tightening demand for whether it be owner-occupier or for rental, you're going to get price pressure. So, you know, everyone can argue, did rents go up, did they not go up? Well, there's evidence that they did go up in a lot of markets, but you've got to go back to the source and say, well, if it was working, why did you change it? And the only argument can be on the supply side, because there was demand in the system. So that is the reason why they adjusted it. In addition to that, we obviously saw, you know, Wayne Swan, the Treasurer, talking about economical disasters to do anything with negative gearing, and that was back in 2010. So at that time, a lot of people did believe that negative gearing played a very, very important role in providing available accommodation and stock to the market to balance out the market. And I think one could argue that when we did see historically low interest rates and easy credit throughout the course of pre-GFC, and even after the GFC for us, we had some pretty easy credit opportunities there, that has meant that the borrowing power has gone up and that pushed prices higher. So, you know, if we were to go back to Tim's slide deck, we could see at that point where 54% of people in New South Wales were investors and it was going out of control. That's the reason why the macro-prudential regulator, APRA, stepped in and made those changes to slow the market down. But they've done that now, and this is my argument in terms of you don't need to reform negative gearing or capital gains because it's already been reformed in regards to we've taken the demand pressure out of the marketplace now, and we now have a lever to do that. We don't need to, you know, bring a very dangerous policy into play to move those levers. So what is it that they're trying to do in this second attempt? It's pretty clear that they have an agenda that they thought was going to be able to raise them lots of revenue, but also potentially provide new supply coming into the market. And that's what I want to try and dispel that myth tonight. So let's just quickly read through. This is straight off their website because it still lacks a lot of detail, and we're really disappointed that we don't have more detail around the policy, but we've just got to work with what we've got to work with. So it only applies for new properties will be able to be negatively geared. All investments made before the 1st of January 2020 will not be affected by the changes to negative gearing and will be fully grandfathered. Losses from investments will continue to be able to be offset against investment gains in some financial year, and regardless of the asset class, and within year losses can still be carried forward and offset against any future capital gains on the investment. So it's a deferral more so than not being able to claim it. But if you only ever buy one investment property and you know that you're going to get slugged a 50% tax increase if you ever sell a property, you may not want to sell it because of the passive income that comes off it. So you may not be able to offset those losses. But if you have share income, you may be able to offset those losses in those years that you have that share income coming through. So it's not diabolical, but it's still diabolical in terms of the economic impact that will have going forward for most investors. In terms of the capital gains tax, will be halved on all assets purchased from the same date, reducing capital gains tax for assets purchased after the 1st of January 2020 from 50% down to 25%. All investments made before the 1st of January will not be affected by the changes to capital gains tax and will be fully grandfathered. The existing capital gains discount that applies to superannuation funds will not be affected, and the 50% active asset reduction concession that applies to small business will also not be affected. So the reality there is that they're not going after super, they're not going after businesses who are potentially divesting of the assets that they've built up. They're going after residential property in their attempt, in their words, to potentially create a level playing field. So, well, I'm sure we're going to get plenty of questions on that, so I'll keep moving. In terms of the impact on demand, so, Tim started off on supply side and then moved to demand. I'm going to start on demand side here. So historically, over the long term, the mix has been around 70% owner-occupier and 30% investor. Now, if you then break that down, owner-occupiers, you saw in the activity of first-home buyers that in general terms, 70 or 80% of buyers are either upgraders or downgraders. They're moving from house to house, and then you've got that sort of 20 to 30% first-home buyers. Now, in some areas like New South Wales and Victoria, in the height of the marketplace, that got down to as low as the early teens. But historically, it sort of sits around that area with some of those incentives that are being introduced by government. The other thing that you need to understand is, and this was the big misnomer that got Labor into a lot of trouble in terms of their data numbers, and that was that 50 to 60% of investors buy existing property, and around 40 to 50% buy new property. And they had those numbers completely wrong. And they were using the ABS statistics around it saying investors buying new property. But we found out that the data collecting is inferior and has mistakes in it. So it doesn't detect what is newly erected property at all. So they've been doing all their modelling. So has the Grattan Institute. So has Lawless in terms of arguing their points. And so their points are now mute in terms of telling us the truth. And I'll come back to that more in a moment. So at the moment, the language out of Labor has been different from when they first started, where they were talking about all this big failure rate because everyone buys existing property and no one buys new, to a more managed, a fairer playing field, or a level playing field is what their positioning is. And that should be a warning to anyone who's looking to invest in property, because this position is signalling that Labor wants property prices to grow at a slower rate into the future, and supposedly keep house prices more affordable for buyers going forward. So you'd be thinking about that. If capital growth returns are anticipated to underperform their longer-term historical performance going forward, then some investors will deploy their investment funds elsewhere. This will reduce the level of buyer demand, and this will also impact on the supply side, along with jobs and economic activity. Now, this theory is supported on many fronts and in several research findings, and I just want to share a couple of those with you. So, Property Council of Australia commissioned a community research paper. Over 1,000 people were phone interviewed, and these were the investors' responses to these taxation changes. Now, firstly, a lot of people weren't aware of these changes. That was one of the interesting ones as an aside. But the key findings from the Property Council's research included that around 49% of all surveyed would be discouraged from investing in property if proposed changes are made, with a further 42% would consider the type of investment property. So you're talking about half of the potential investors saying, no, I'm going to look elsewhere. And of the other half, 42% will say, well, it potentially may impact what I buy. So there is this buyer behaviour challenge that's going to occur because of the unknown situation with this policy in terms of what buyer activity will do. Current investors would also be most discouraged from investing in property under the proposed changes, so 58% compared to potential 40% of investors. So current investors are saying, you've really, you've knocked the wind out of my sails. I'm potentially, again, going to look elsewhere. Now, again, that's a clear and significant change would occur in buyer behaviour, impacting future demand on property and then putting further pressure on current house prices. So it's important to understand that. In addition to that, Labor believes that this incentive of keeping negative gearing for new builds will encourage buyer demand to shift from existing to new dwellings. So I thought it would be important if we took a look at some of the research that's come out in terms of the performance of off-the-plan properties. So since 2011, this data was analysed by BIS Oxford Economics in their research report called The Perils of Buying Off the Plan. Now, 2 out of 3, 66% have zero or negative equity today. And you saw in Tim's presentation as well, the number of properties that are coming in at under cost of sale or contract of sale prices. So these people are starting off with negative equity, and that's through their Valex platform. That would be owner-occupiers and investors, and so is this data here. Now, 48% out of Brisbane, 1 in 2, and in Sydney since 2015, 23%. Now, that's in Melbourne and Sydney, where they have been booming markets. Again, Tim talked about from peak to trough around 70% in those markets in terms of capital growth. And if you were listening intently, you would have heard Tim talk about the future supply that is coming online in the unit market. And, you know, there's literally hundreds of thousands, over 100,000 apartments that are going to come online that have potentially been pre-sold, and those people may have a zero or negative equity position. So I suspect there will be a deterioration, certainly in that Sydney market, in terms of those people who have a very, very poor outcome on those off-the-plan purchases. So this definitely does signal that buyer behaviour for investors will avoid this stock. So as this becomes more and more common knowledge of what is investment stock versus investment grade properties, buyers will be more sensitive and more aware and more educated to potentially avoid some of this stock. So I think that's a really good message for you, budding investors out there, in terms of what you're going to be doing around watching what that buyer behaviour will be, because ultimately if we don't have that underlying demand, you're going to see price corrections. So continuing on, as we move from the demand side, let's now start to think about the supply side. And so following on what we believe is going to be an anticipated decline in demand, the next question is simply, how will you increase supply? So Labor obviously took their lessons from 1985 to 87 and did realise that there was a lot of correction in regards to declining construction. So they needed to look at some further incentives to potentially do that uplift of supply, not only for making sure that rents don't increase too much, but also to give some incentives out there to maybe shift people across to new property. So this is what they've come in as part of their portfolio of offerings for property investors and the property market. So they've got a build-to-rent scheme, and in this particular case, the big end of town is going to get a 50% tax deduction. So they will only be charged 15% tax instead of the 30% tax rate if they go and build these properties for rental. So if you think about that, that could potentially incentivise medium and high density construction. I don't know how that's going to go in regards to building lots of houses. I don't think the numbers would work, and I'll talk about my observations of that in a second. Secondly, Labor will spend 6.6, that should be billion, not million, my bad there, little typo, in rental subsidies. So again, they take it from the mum and dad investor and then they regurgitate it in terms of paying $8,500 towards investors who build 250,000 new affordable dwellings to rent over the next 10 years. Now, that might look like a lot of property, but if you think about that over a 10-year period, it's not a significant amount. And then obviously the final one, which we all know, is that negative gearing will remain in place for new property. So I put this chart next to it, and that's what Tim was showing us earlier in terms of the spike that we saw here in Brisbane and also Sydney in terms of some public and social housing, but it has been falling off a cliff, and Tim's given us an updated number on that. So will it be enough is my question. And so my observation on this is the rent to build, the return on investment is still a real struggle, even with a 15% tax rate. It's very, very expensive to provide ongoing housing for these people. The expectations of the people who move into these is that these properties will be kept in a very, very high order. There is usually a lot of renovating and repair work going on in those particular properties. And in my view, that's why governments have got out of this particular space, because it is very, very costly, and they don't run those investments as efficiently and as well as mum and dad investors who are using good property managers. So I still don't know whether the business case will stack up, and I definitely don't think it will stack up for houses or townhouses. So there will still be a huge amount of people who won't want to live in medium and high density accommodation and want to live with a little bit of dirt under their feet. The first attempt at subsidies in terms of rental accommodation was their NRAS program. This, in my view, has been, on the majority, a failure. There have been very frustrated investors. It's very convoluted in terms of the ownership structures, and overall, because of that, the secondary market has been pretty dormant in terms of interest in buying those particular properties, and that has led to very poor capital growth on those particular assets. So I'd be interested to see what the policy, more detail around their new rental subsidy, the $6.6 billion they want to spend over 10 years. And thirdly, as I highlighted earlier, generally speaking, the smart investor is usually going to avoid buying new properties because it will get a poorer return. So they're going to get their better return on their money elsewhere. So from my point of view, as that becomes more and more common knowledge, we're going to have this problem around this secondary market in terms of resale, especially what we saw in terms of the performance so far of those properties, when the second buyer at the moment can buy that second-hand property and get negative gearing on it. As of the 1st of January, if their policy is successful, there will be very little demand for those properties. So I do care a lot for people who are buying medium and high density accommodation and thinking that they're going to get a good return, especially when they start thinking about their body corporate fees and their maintenance and repair fees and their holding costs of those types of dwellings. So further to that story, on the supply side, when you have the Masters Builders Association, which represents the building industry, you would think that they would love a policy like this, right? Because it promises to build new properties. And that's exactly what they want their members doing. They want their members building. But sorry, unfortunately, that's wrong. They also modelled independent study through Cadence Economics. If Labor's policies are implemented, it will mean in them up to 42,000 less dwellings being built across Australia. So for me, it's a good, the Labor Party should be listening to the feedback from these subject matter experts. If they're saying, look, I like what you tried to do with this, but it's not going to work and these are the reasons why, the Masters Builders Association, they get it. They realise that demand will fall away and hence so will supply. This is in a time where we're seeing new dwelling approvals are already in serious decline from their peaks. Once again, the idea of the secondary property market with less demand under Labor's policy will restrict new investment funds flowing onto or should be into property there. So I just think it's really important that we understand that Labor's proposed policy will result in a decline in new housing construction, which will have adverse flow-on effects to the property owners, renters, and the economy as a whole. So here's what we did see in terms of what are those flow-on effects. So the flow-on effects we see here are based on SQM research, and this is very difficult modelling, and I don't think anyone could sit there and say they're going to get this perfectly correct. But what we are definitely going to see is further declines in the property market if this policy gets up. I still think there will be pockets of the market that will see growth, and I think that will all be doing with land banking closer into inner city areas. We'll talk more about that one day. But you're going to see there Melbourne, a 16% fall, representing a further $100,000 off the typical value of any home in Melbourne, not just investors' properties, but every homeowner. 14% in Sydney, 127 and 7% in Brisbane, which is typical $40,000 in terms of impact. Now, you also have Riskwise, who also research the impact and the consequences of policies like that, and it's very clear on their graph over here that they've got some relatively similar numbers in terms of where they see further declines because of the slowing demand and the lack of appetite from investors coming into the market, remembering that they represent 30% of the marketplace. Increased rents. So the argument here sort of flows on from the lowering demand, less supply, rental vacancies will tighten over time, as they did the last time Labor attempted this policy. Fewer investors coupled with less construction of property creates a shortage of rental accommodation. High demand, low supply will lead to higher rents. Couple this with investors being forced to pass on some of their increased cost in not being able to offset the interest expense under Labor's policy. And you have effectively the perfect storm for renters. Now, again, Labor's sort of thinking they're addressing that by a couple of their other initiatives, but I still have a question mark over those. The consequences of that is they're forecasting rents to rise as much as 22% in Brisbane over 3 years, 20% in Perth, 50% in Melbourne, etc. So what's the impact of that? Two-bedroom apartment in Brisbane, currently renting $420 on average, 22% is $90 extra a week in rent, or a $5,000 increase in the rent for a year. So again, that is material. So the removal of negative gearing will lead to increased rents. And I know you get the sound bites, lower prices and higher rents. That is the potential reality of the demand and supply curves that are being impacted in the marketplace. Then we go on to what's the flow-on consequences. So the flow-on consequences is the construction industry is one of Australia's biggest industries, both direct employment and also indirect employment. And that has been a real catalyst for why we have effectively avoided a recession after the mining boom. We were able to redeploy those trade people into those markets, and you saw that in the net migration from different areas of Australia where the jobs are. And as I said, the vast majority of jobs are in construction, so and the indirect jobs there. So in terms of what we're looking at here, that was before Labor learned their data was wrong. So when they talked about their jobs, they were talking about, creating up to 25,000 new jobs. And where they went wrong in their data was what we just talked about before. They were using a figure of 4 to 7% of current investors were buying new property. Through the work that we did here, through calling around the industry, we worked out very quickly that figure was more like 45% and not 7%. Then Labor's modelling was then disclosed through the Parliamentary Budgeting Office, and what we saw from that was their modelling showed where those 23,000 new jobs were going to come from was the movement of people, investors not buying 7% new, but buying 22%. The problem with that is, as we just talked about, they're already buying up to 44%. So this would actually result in a decline in jobs, not necessarily a spike in jobs, and that will also flow onto their revenues, which we'll talk about in a minute. This means under this policy, housing construction likely to go backwards rather than forwards. The industry view is the downturn in construction will have a flow on effect to jobs. Masters of Builders Association's report shows that up to 32,000 jobs are at potential risk under this policy. So again, the proposed policy will create more jobs. It actually won't. It's more like fewer jobs. In terms of moving forward around these tax revenues, in 2016 they claimed it was around 32 billion. The remodelling that they did, they thought it might even be as much as 35 billion in savings. Again, Labor was using those assumptions based on their failure rate of the current system without really knowing that the evidence supported 45%. That evidence was validated through AFG, who represents 60% of Australia's brokers, and the brokers write 60% of the market, and their data was showing 43% of their property investors were buying brand new properties currently, And then we had market-leading BMT tax depreciation. They were quoted, Bradley B was quoted as saying he believes that it could be as high as 50%. And if you think about all of that new apartment stock that's coming online, that's most likely being bought by investors, that's probably about right over the course of the next couple of years, as more of those investors who have bought off the plan and are waiting for those properties to be built, are going to be stung by that as well. So unfortunately, Labor's assumptions around their modelling will be incorrect. We are waiting. Labor has promised that they will release their costings, and we just wonder what figure they're going to put in terms of what is actually brand new properties being bought by investors. Because if they do a model, we think that if they do a model of 40 or 45%, the numbers are completely shot, and it may not be a net gain at all. So we wait with bated breath on that one. Do I have something over here? Sorry. Labor's modelling, we called it out. That's what it is. In terms of, and this is where I'm going to introduce Peter, Koulizos. Peter, if you can take your microphone off mute and say g'day to us to make sure you're with us.
G'day, Ben. Hello, everyone.
So I don't have to talk about this, Pete. I think you can lead the way here. So tell us about the analysis that you did in regards to the modelling.
Well, so Labor think that they're going to save $32 billion and help the budget out, but the reality is quite different because, firstly, if you disincentivise people to buy existing property is where most of the capital gain is made, because new property traditionally doesn't grow as much as existing property. So yes, they will save some money in not dishing out as many negative gearing benefits, but they're going to lose much more in the collection of capital gains tax revenue. So that's one side of the coin. The other side is if you encourage people to buy new, well, new property has greater depreciation benefits and it has less capital growth. So on the one hand, you're missing out on capital gains tax revenue from existing investors because they've pulled out of the market. But on the other hand, you're going to give more money out to investors that buy new property, and you're going to collect less in capital gains tax from them. So it just doesn't make sense so far as the budget is concerned. In the end, they are not going to save money. They will lose money because they will be dishing out more in negative gearing benefits than they will be collecting in capital gains tax.
Thank you, Peter. That was well explained, and I like that the truth around, yes, if there is more depreciation, well, they write that off, and so they lose those tax receipts as well. So it doesn't quite. I'm fascinated how they got to those numbers, and I'd love to sit down with the Parliamentary Budgeting Office with the experts just to see what sort of assumptions they were using, because they baffle me in regards to where this net gain is going to be, considering that, existing property owners are already buying you at around that sort of 40-45% range. Now, what we also know, from this particular policy is that under Labor, we will then be one of the highest taxed countries in the world when it comes to capital gains tax. So you can see us here in terms of where we currently sit, is sitting here. Under this, where we get an increased 25% tax, an increased 50% tax on our capital gains, moving from 50 to effectively 75% taxed. We'll go to the highest of England for property, the USA, also England for shares, Japan, Canada, and our neighbours across the ditch. So that's also something to consider. And I also thought it's important to highlight that, that there could be an argument that you take revenue from one area and there's going to be consequences on the other area. And this is what I'm talking about, state versus federal taxes. So we have seen that when the property market is booming, the state coffers get filled up incredibly quickly in regards to the billions of dollars that they earn through their higher stamp duties and also the appreciation of the land tax. And so $30 billion flows into state and territory governments' coffers in regards to land taxes and state-based taxes. And so the Housing Industry Association, the HIA, did some modelling on this, and they believe it's around $1 billion a year that will be falls driven by this particular policy. So you pick up $1 billion on one side and you pay out $1 billion on the other. I don't quite get it. And if that is the case, what do you think the state governments are going to do in terms of wanting higher tax revenues? The logical conclusion of that is going to be GST would be an important revenue source for the state governments. So that could put pressure to be able to provide that accommodation, not only in the tax receipts, but if the property investor departs, who's going to pick up the slack on social and public housing? Well, that's going to come down to the states and territory governments. And if that happens, we're going to be paying higher taxes in terms of higher GST revenues. But there's also a sneaky thing that I think, and ABS wouldn't be to blame for this, but somebody's made this decision that they actually take out state stamp duty. They actually don't call stamp duty a property tax, which is astronomical in my thinking. What is it then? They call it a services tax. My goodness, what service do you provide where I pay $20,000 or $30,000 in stamp duty? I don't feel like I get those services. It's a property tax. Let's call it what it is. If it looks like a duck and quacks like a duck, it's a duck. So you can see there also the stamp duty revenues nationally, are coming up to around that sort of 21 billion. Now, as the property market slows down, those revenues again could fall. So it's always important to understand exactly what's at risk here. Now, that big supply of new stock that's coming on will keep the coffers going for a year or two, but after that, it could potentially fall off a cliff in regards to those state revenues, and hence putting pressure on state taxes. And back to that GST story. Now, I thought, well, it would be important. Now, this is a very busy slide, so I don't think we're going to get through it all, conscious of time. But what I did do is I ran the numbers, okay? So I'm someone who's buying an investment property with an 80% gearing position. I worked out exactly what sort of tax benefit we are getting and how much property investors are paying, and are we paying our fair share of tax? So this is the federal level, okay? So the summary of this, we can see over here, there is the tax benefit that we are getting in terms of the negative gearing benefit, as we call it, in covering our costs. And this is us paying tax, okay? So there's all the tax that we are going to pay. So in the bottom line here is that this particular investor, Mr. and Mrs. Typical Australia, who bought a $600,000 property, would receive around $29,000 over that 11-year period as it goes down, as the property starts to grow in value and the debt's paid off. And then you can see here in terms of the remaining period over that 30 years, they will pay $167,000 in net present value. That's $81,000, net present value $26,000. So, upwards of three times more than three times more. Overall property income paid to the government is positive by $157 or $91,000 for one property over that period. Now, if they choose to sell that property and the current exemption was to be in place, they would pay an additional $300,000 in tax over that time if the property was to grow based on the assumptions that we've got down here. So potentially tax payable of $464,000 in addition to the stamp duty and the land tax that they're paying to state governments would also be tens of thousands of dollars. And we've done those numbers as well. And you're going to see them for the very first time here tonight. So obviously some of that is in future value terms. You're assuming that these properties will grow with inflation. So indexation we've got here running at 3% per annum. So, but that's a lot of schools and hospitals for, 2.2 million property investors. So that's just the federal side. So I think property investors, we're paying our way. And let's have a look at the state-based side here. You can see this is where the land tax is in terms of what's kicking in and what you're going to be paying. Now, this is focusing on land to asset ratio of 55%. I've got to vet these numbers. I'm just quickly looking at New South Wales and I'm thinking, wait a minute, that looks a little bit light on. I'm paying land tax there already, and I know my property land values are a little bit lower than that, so I'll circle back and get those numbers corrected if they are wrong. But it just gives you a bit of an indicator that's definitely wrong. This is more like it in terms of, look at the ACT. That's why we don't recommend buying investment properties in the ACT. Tasmania is also a shocker. Whether they get to those valuations is another question down in Tassie, but you can see the indications of that in terms of the tax that you're going to be paying. That's in addition to the stamp duty that's going to be charged to you. Here is where we pay our taxes for our fireworks at the end of each year. I'm obviously being facetious, but you get the picture. So there's a lot of money that property investors do pay, and we're doing this in an effort to try and be less of a burden on the tax purse when we get to retirement. So it doesn't make any sense to me that we would be slugged further, and that's the importance of having the association. The bigger we grow, the more lobbying influence we will have, and we vote. And when we get to a large size, we will be able to make sure that we won't be treated as second-class citizens, and we won't be referred to as greedy property investors when we're basically helping out the economy in a very, very significant way. So a couple of things we just also want to highlight here. The questions we still want answered from Labor, you can see them here. I'm not going to go through them now. You'll get them in the slide deck when we go through, but these are some of the big important questions that we want answered. They're not going to answer them because I'm not sure they absolutely know until they consult with industry, is what they've told us. So the devil's in the detail. We'll come back to you and report as soon as we know on those questions. I've got those out with journalists at the moment, trying to get some answers, but I don't think we will get them. My final thoughts to this is, if the industry is telling you that it's not necessarily a good idea to be introducing this policy in the first instance, and a terrible idea to be introducing it now when property prices are already correcting, please listen to the subject matter experts. They know a thing or two, and you might say they've got vested interests, but they've got the vested interest in terms of jobs, the economy, and prosperity. So if they are vested interests, I think they're pretty good vested interests for the broader economy. So now we're into Q&A. So thank you very much for hanging around. I'm conscious of time. How are we going, Nina? We're on time. We're a little bit over. Okay, so let's get into some Q&A. So are you both with me there, Tim and Peter?
Yep, I'm here.
Yeah, Ben.
Fantastic. So, Tim, I want to start with you. One of the questions I have in regards to looking at your slide deck was around whether you potentially see the short-term buying frenzy if Labor win government. Do you anticipate a spike in demand as investors try to put beyond reasonable doubt that they're going to be able to get that negative gearing benefit on those properties?
I think there probably will be some level of pull forward of demand from investors who are seeking to get grandfathered, both from a negative gearing perspective and the capital gains tax. That makes sense to me, but I think that pull forward of demand could be dulled a little bit just by the overall uncertainty around what the resale environment is going to be like. So to put it this way, if you do rush into the marketplace to get grandfathered, at some stage you're going to want to offload your property. And if the person you're looking to sell to doesn't get the same taxation benefits as what you do, or what you currently have, then your market is generally going to be minimized. In some cases, quite substantially, particularly if you do own a property in a very investment-centric product type or region. So I think that's going to be the back of a lot of investors' minds is, what happens when I go to resell, and is my market demand still going to be there if prospective buyers don't have the same taxation benefits?
I think that raises also a good point, Tim, about, we talk about remembering that 70% of the owner-occupier is is strong demand, right? So I think in reading between the lines, what you're saying there is, be careful of investment stock. It's similar to, the classic investment stock, which is the student accommodation, the service departments, those types of things. But there will be risk in terms of getting into standardised investment accommodation, as opposed to really focusing on assets that have owner-occupier appeal. So you do get that competitive tension that will hopefully lift your price over time.
And definitely expand your resale market. Absolutely.
Yeah, terrific. So a couple of the questions that we've got coming through. Peter, do you have a question at all for Tim, or vice versa?
No, I was very impressed with Tim's presentation once again. How are you, Tim?
Good to hear from you, Peter. It's been a while.
Yeah, it has, mate. It has. I hope all is well on the Sunshine Coast.
It is, mate. Thank you.
All right, gentlemen.
Don't worry about us, Ben.
Yeah, you guys keep catching up. I've got one here from Shashank. Does interest-only loans make sense for investors still? And the question, as the mortgage broker in the room, I can definitely tell you that if I was looking to invest in property, interest-only would be part of my consideration, especially if I had an owner-occupied debt as well, because the interest-only component, whilst it remains negatively geared, and even if negative gearing wasn't taken into place, that expense can be carried forward and will be offset against any future losses that I might hold. So I definitely feel for investors that interest-only should be in the mix when you're sitting down and talking to your accountant, and also when you're sitting down and talking to your broker. So hopefully, Shashank, I've answered that one okay for you. Pete's got a question here saying, do you expect a further 16% drop or another 6% from where we are now in Melbourne, in reference to the SQM and the RiskWise reports? That was an additional, based on, I think for SQM, it was at the start of February when they released their report. So that was an additional decrease from the current levels. Is that the way you read it, Tim or Peter?
That's the way I read it. Absolutely. We're currently seeing Melbourne values down about a little bit more than 11%, Sydney down by nearly 15%. And our expectation is we will continue to see this moderation in the rate of decline. But of course, there's a lot of moving parts that could affect that forecast, be it interest rates moving lower or the change of government or anything happening in the global economy.
Yeah, I agree. I think when this is implemented, the losses would just add to the losses that people have already experienced, especially in the Sydney and the Melbourne property market.
Thank you, gentlemen. Now, Daniel's asked a question. Do you know if the proposed changes to capital gains tax are limited to resi property, or will commercial also be affected? Thank you. Any idea, gentlemen?
No, I don't have any idea, but that is an excellent question.
Maybe check with the documentation. I thought it was across the board for any investment.
Because I know it moves over to shares as well, so it probably does include commercial.
Well, interestingly enough, I've been having some interesting debates with some of my colleagues in the real estate industry around whether it is related to shares, and I've got two different views, and I've done my research, and I've got two Labor things saying two different answers on shares. So I don't think it is on shares. I think it's only on residential property. It may also, and so don't hold me to this, but I think it's got something to do with the vehicle. So in other words, if you're buying in your own individual name, is the reason the negative gearing. So if you're buying in a company name, and this is one of our questions that we've got out to Labor right now, if you're buying a company name, you're in the business of property and you should be able to claim that expense. If you're buying in your individual name, that's technically the negative gearing against your other income, but effectively the company is generating that income. Otherwise, that would mean every company in Australia would not be able to claim their costs, which doesn't make sense to me. But it is an excellent question, Daniel. We wish we could answer that for you before the election is out. As I said, we have that question into the Australian Labor Party to try and give us some clarity around that. But I think in most cases, people buy commercial properties in different vehicles as opposed to their individual names. So we'll have to just wait and see in terms of clarification on that. Tim thinks it might be applicable. Maybe ring your local Labor member and ask them that question. All right, next question here is from Darren. I think you are preaching to the converted. we're all on the same page as you. How do we get the penny to drop to the general public re Labor's policy? I just got that piece of paper right in front of me then. I hadn't pre-read that one. I'm going to answer that question for you in a minute, Darren, because I think there is something we can do, right? And that's where united as a group, we should be in a good position to be able to do that. Hamish just quickly asked how many members does PICA currently have? We're pushing up towards 2,700 members that are committed to us. We're growing at around 5 to 10 members a day. But I do ask all of you that are on this call and this webinar tonight, and you're listening to the replay, do us all a favour and find one new member for us. That one new member will get us moving very quickly towards our 10,000 member target, which is our first critical milestone in terms of what that looks like. How can PICA get this data to the opposition? We've been doing forums around the country, educating both the opposition as well as mortgage brokers and real estate agents about these potential changes. We are working in that, and I'll talk more to how you can help promote that and how you can get educated and share that information. Thank you for those questions, Hamish. Charmaine, if you knock down and rebuild an existing investment property, is that classified as a new property? What might it mean under Labor? Brilliant question. That's one of my questions again to Labor, because if I'm thinking about it, if I buy an old property closer to town, I knock that down and build 2 townhouses, which I suspect will be a new a modus operandi for most investors who can afford to do that, putting pressure on land values closer in. I do see that as a means by which there will be some strong capital growth in land in our very tightly held areas. So the argument is, well, is it new? Do I build it new? Can I get negative gearing because I own the original property and I roll that over? I think that is a critical question, because if you can't do that, I really don't know how Labor's going to get the supply that they need. And the only supply they might get is high-rise and medium-density apartments, and that's not what everyone in Australia wants to live in. So, Charmaine, as soon as we know the answer to that question, again, Labor have not consulted with industry in any respects to any of these policies. They have used the academia world to potentially run their models, and that's why their data's wrong. So hopefully we look forward to the engagement with them if they do win power. But damn good question. Next question, Peter. There should be no capital gains tax to encourage more investment, as no capital gains means can be moved easily without penalty, which is a good question around some of the arguments from the Housing Industry Association around stamp duties, that it's a prohibitive tax, that it doesn't allow for easy movement of ownership. In New Zealand, Peter, there was no capital gains tax, only that's about to change, but ultimately that is a good question around whether we should have that. So New Zealand are going to be introducing capital gains taxes, I believe, for investors, and I'm not sure about owner-occupiers, but nice comment, Peter. Unfortunately, we can't do anything about that. Ed's got a question here. Is there any particular reason why investors favour New South Wales other than expectations of continued capital growth, which is unlikely to eventuate in the next 5 years or so, in my opinion? So, Tim and Peter, would you like to share your view on why New South Wales is a property mecca?
I would hazard a guess that it's probably a high concentration of foreign investors, because generally foreign investors favour Sydney and Melbourne, our 2 major capital cities. But Tim might have a different perspective on that.
Yeah, I'm not too sure. It's I mean, it's based on housing finance data, and we don't see a lot of foreign buyers being funded by Australian banks anymore. So maybe that doesn't show up as much as you might think. You know, maybe it comes back to herd mentality. That's generally where most of the investment has been over the past decade, and it's got some momentum. But yeah, it really does seem a little bit strange to me that we'd still see about a third of mortgage demand in New South Wales being investment related, whereas most other states were quite a bit lower. Well,
there's no, having lived through the boom of 2001, to 2003 in Sydney. Yeah, when the market's moving, there is no doubt a real FOMO experience that's going on there. And I felt this time around it was very similar. And that over-exuberance in any marketplace will always mean we overshoot its true value. So we did see a bit of that. I think, you know, if we think of the demographics and the demography studies, that both of our two biggest centres are our knowledge centres and our financial capitals, and with that comes, you know, very, very high income earners, and, you know, propensity to live in some beautiful areas with lots of strong livability. And I think that's probably the consequence of you know, that scarcity value in those particular centres, and why we see, you know, beautiful property in these international cities, commanding premium prices most of the time, and you know, they do have breathers every now and then, but they continue to experience high capital growth. So, you know, in terms of what that science is behind it, well, we just look at the demand and supply. You know, once you sort of understand that human behaviour and human interest and economic activity, that's the way in which we try and approach it. Okay, next question comes from Darren. When Labor assumes new investment properties only accounted for 7%, what were they forecast, or 7 to 22%, what were they forecasting the change in policy will result in this figure being? Well, Darren, what they forecast was they were saying that currently it will be 7, but once their new policy gets in, it'll move to 22. And so that is the problem with their data, right? It's already sitting at 45. So their models are shot. And so now they're scrambling. And my understanding is so is Treasury. When Treasury said a modest impact, and when you hear the Labor rhetoric around, oh, look, you know, Treasury's have modelled it, PBI have modelled it, Grattan Institute have modelled it, and there's only, you know, it's a moderate impact to property prices. Those models are wrong. And they have been proven to be wrong because their data, you know, crap data in, crap data out. So that's our challenge. They moved it to 22 thinking they're going to get this big economic spike, but it is already sitting at around that sort of 40 to 45. So that's why I took them to task once we got confirmation of that data, because I've always believed that it was around 50-50 in the 20 plus years that I've been doing this. So that's also good to know. Michael, great job, guys. My question is to Peter. Where should I be looking in Adelaide market, please, Peter?
Something completely different. Michael, just quickly, because I know we're talking about something else tonight, I'd be looking in the gentrifying inner western suburbs of Adelaide, like Torrensville, Thebarton, Mile End, Richmond, Underdale, Kilkenny. Those are the sorts of places that I would be going for. If you know me at all, you probably know that I'm a big fan of gentrification, the ability to get into areas which are run down now, but that improve over time. That's where I'd be going.
Beautiful. Thank you for that little tip there. We've got hot spotting in tonight's webinar as well. Tanya asked this question, and I think this one's I'd love to hear Tim's response to this as well. If property prices come down, what will that impact on demand for rental properties? I.e., this is the argument that I've also heard from the Grattan Institute, people purchasing rather than renting and therefore reducing rental price increases. So in other words, we're sort of saying that there's going to be zero population and no one's going to arrive in Australia and there's going to be no demand of people moving intrastate. What's your view on that, Tim?
Yeah, that's generally one of the retorts from people defending the Labor policies, is that as prices come down, we'll see more first home buyers coming into the marketplace and see some rental demand alleviated, which potentially could, you know, be part of the outcome. You'd have to expect as affordability improves, there is going to be some improvement in first home buyer activity. But, you know, look back through time, even when housing affordability was remarkably much less challenging than it is now, and we still saw roughly around about a third of the marketplace, or a third of the households across Australia were renters. So I really don't see that holding up. There are always going to be some fairly significant proportion of households that are renting for one reason or another. be it lifestyle reasons or preferences, or simply they're fairly young and haven't had a chance to build up a savings strategy just yet. So I'm not sure that's going to pan out.
Oh, 100% behind you there, Tim. Do you have a view on that too, Pete?
Yeah, look, because the assumption is that young people have a huge deposit and just waiting to jump into the property market. You know, that's not the reality. The main reason first home buyers are not coming into the market is, as Tim mentioned before, it's the ability to come up with a decent sized deposit, or really the relative lack of government assistance to buy property. Because at the moment, it's around $15,000. It only applies to brand new property, and $15,000 is not much when you compare it to the fact that when it was introduced in the year 2000, it was $7,000. So it's just over doubled in 19 years, whereas property prices have probably gone up 4 times in that period of time. And now the other point I want to make is, because you know, stats can tell a different story depending on which story you want it to tell. And I know it's, you know, Thursday night, so I won't make the numbers complicated. But if there were 100 buyers and 30 of them were first home buyers, that's 30%. But then if sales had gone down, as Tim showed us before, and they went down to 50, and we only have 20 first home buyers, well, they're 40% of the market. So somebody might think, oh, beauty, first home buyers have increased to 40% of the market. But the reality is, in absolute numbers, they've come down because there are less sales overall. So we need to be careful of the figures, but I've got 4 kids between the age of 21 and 30. I teach at uni where there's a lot of kids with, you know, we talk about their aspirations for housing. Things have changed. The generations have changed. Not everyone wants to buy a house like they wanted to do 30 years ago. And even those that do, you know, they spend their money in other places. So it's harder for them to come up with the deposit.
Well said, Peter. Thank you for that. Here's another one that I seem to be getting in the social airwaves before we close out. So I'm conscious of Tim and your time, so maybe a couple more minutes if we can, gentlemen. When it says, so this is from Peter, another Peter, failing markets mean cheaper buys. I regret that it hurts people, but I will be very happy when the market falls like in Japan 1990. Also good for population as a whole to be able to buy cheaper properties. Is that good for the economy? And do you agree? Is this good news? I'm going to weigh in on this one, but I'm not going to go first.
Look, when you're speaking relatively, you know, if my property goes down in value and I want to buy somebody else's property and that's gone down in value, well, that's great. But when I get to my last house and I want to move on, just because property has dropped in price doesn't mean utilities have dropped in price or cars have dropped in price or the other costs of living have dropped in price. So it might be okay relative to other people purchasing and selling homes, but when you get to the end, that's a very different story.
Tim, do you have a view on this idea that, you know, the argument of the young people sometimes is that, oh, this is going to be great, property prices are going to be cheaper for us all to buy in. But what about when they do get into the market?
Yeah, so at face value, that seems to make sense. But think about it from an economic perspective. You've got about 50 or 52% of household wealth is held in the residential asset class. If you see a material reduction in household wealth across Australia, then you start to see people spending less. So about 60% of the Australian economy is consumption, people going out there buying things, spending. So once you start to see consumption getting reduced, particularly if it reduces a lot, then that's where you start to get a big hit on economic activity and economic growth. And then that, of course, leads to a recession, which leads to fewer jobs. So there's a massive domino effect here. Really low housing prices end up eroding household wealth. And then everything that happens after that is generally very, very bad for the economy.
Yes, as much as Peter was sort of probably trying to be a little bit opportunistic there, Peter, I concur. The last thing we want to see is broader economic activity deteriorating and the level of our wealth and our prosperity declining because the consequences are that property market is too big to fail. We don't have to look too far back into the past to see what the GFC was created by, and that was property-led out of the US, where there was no recourse borrowings and the system wasn't well regulated. If we see a property market crash here in Australia, which is highly unlikely, but if you did see that, you would experience what a recession is like of the 1990s. And a lot of older people will tell you, especially in Melbourne, during that time where it was very hard, people were losing houses, the economy was sluggish. Having a job meant you had purpose. There's so much economic health consequences associated with that. So you never ever want to see a market retracing its steps too significantly, especially given it is, where all of our wealth is stored. So I'm always a believer that, yes, I want to leg up to see people get into the property market and owner-occupiers, first home buyers coming in, but I don't want to see that as a consequence of the rest of the market deteriorating. And I mean, if you think about it, from a number sense, like Peter was doing before, if I buy a $500,000 property and I borrow $400,000, over the next 20 or so years, I might pay about $300,000 in interest in addition to the principal that I've paid off. So that property is going to owe me $700,000 to $800,000. Now, if we go through a generation or two where property prices don't grow, the question then is, why would I own a property if it actually hasn't delivered me some type of wealth return over time? And if it became a second-hand good like a car, that would have significant ramifications to our broader economy. And I'm with Tim, the wealth effect, consumption, the whole piece. So it would be diabolical. And again, it's not going to happen. I don't want to scare anyone on that, but we don't want to be opportunistic. We want a prosperous society with a prosperous economy, trying to get people in where we can. A couple of things here. Ty, last couple. Has Labor provided any response to your questions in relation to the issues of the underlying numbers the public relies on? They're not going to change their message this late in the election. They're not going to admit that they got it wrong. They will talk around, this is the politics, they will talk around the edges and hopefully, get their seat in Parliament, and that will be the situation. So unfortunately, you're not going to see any changes from Labor's language this close to an election. And Frank, I think it's a good one to finish on because it again leaves more questions than answers under this policy. If I owned a property before proposed negative gearing comes into effect, but it was my principal place of residence and not income producing, after the 1st of January, could I still turn it into an investment property and lease it out and get negative gearing benefits on my remaining debt? Frank, it's a great question. It's another one of my in-the-box questions that I would love to know the answer to. So if Labor are true to their word, if you purchased that property before the 1st of January, you might have purchased it 4 years ago. That is the question. Would you be able to negative gear it? And I would be hoping that they would honour that because that would ensure that it's not grandfathered. In fact, it's retrospective. So I'm hoping that I'm right there, Frank, but the devil's in the detail. If Labor gets in, if Liberal gets in or the Coalition get in, we don't need to worry about it for now. But thank you for those questions. So, look, wonderful questions, guys. There are so many more questions we can get on to. I'm just going to ask Tim, any final comments from you, Tim, from you in terms of some tips, advice or anything?
I think the most important thing is to watch the credit flows. If you want an idea of where the market's heading, that'll probably provide the best indication of whether or not housing demand is starting to improve. Like I said a couple of times throughout my presentation, this downturn is very different. It's happening against reasonably strong economic conditions, particularly in New South Wales and Victoria. It's very much about tighter credit. Potentially, we're in a new normal. So that means that for prospective borrowers, you generally need a larger deposit, lower debt levels relative to your incomes, and that lenders are going to really scrutinise your expenses and your serviceability much more than they would have in the past. So I think any prospective buyers probably need to keep that in mind. And those that do have the funds behind them, the capital and the equity, are probably in a much better position than most others, because they'll find that they are the quality borrowers that receive the lower mortgage rates.
Brilliant advice there. We had to leave it to the end, but I mean, your whole presentation has been full of great insights and great advice, Tim. So once again, we thank you very, very much for your time on tonight's webinar. And again, I encourage you to subscribe to Corelogic's newsletters and see all the insights. Tim does a wonderful wrap each month of each of the markets and video series that I would encourage you to get a sense of his commentary around what he just talked about there in terms of where he sees the broader market heading. And also, Peter Koulizos, thank you very much for your contribution tonight. Again, I would say, how can they follow you, Peter and Tim? Tim's on Twitter, on social handles. Have you got a social handle, Peter?
Yeah, I'm on Twitter, LinkedIn, Facebook.
Fantastic. Okay, so let's moving along. Thank you, gentlemen. I'm going to finish off with what is our call to action. So what are the things that you can do? Coming back to Darren's question around, okay, we all know here in this room and on this webinar tonight that we are preaching to the converted. So what can we do? So I've got some advice and some tips to guide you through this process. In getting the message out there for now, it's really around a social media action point. If you're on socials, if you're in networks of people, then please, this is what we want you to do. We want you to use the facts that you have learned from tonight to bust the myths and the fake news that's being promoted out there. We want you to share our posts, whether it be Facebook, whether it be Twitter, whether it be LinkedIn, and also Instagram in terms of that. There is also some videos that we are working in conjunction with the Real Estate Institute of Australia. If you find those videos, reshare them, repost them, get them out there as well. We want to acknowledge and support those who agree with our position. So if you're in chat rooms, if you're seeing commentary around that, and there's people out there who share the same view with you, say, I agree with you, we need to get the word out there. When you are posting, and I encourage you to post, once you feel comfortable, start putting the PICA link at the bottom there so they can know about joining the fight, to be part of an association that's run by property investors on behalf of property investors. It's really important. What we don't want you to do is get personal. We want you to play the ball, not the man. Okay, so don't attack Labor. We're not attacking Labor, we're attacking this policy or their policies in this area of housing. That also goes to any person that you communicate to on social media. Don't respond or don't respond to personal attacks, and don't attack anyone personally. It is an emotive issue for some people. Move away from the emotion and stay on the facts in terms of telling that story, and share the information you've learned tonight. I am going to be doing more and more socials in the lead up to the final election, and so it's really important that if you are interested in being a volunteer and working with me and being more active on social media, then email info@pica.com.au with the title Happy to Go Social, and I will be in contact with you shortly to be able to provide you with areas of information and some of the questions that I've already answered on social, so you can repeat my responses to get the message out there. In addition to that, effective from tonight, that we have launched a donation page. We know that our membership is only $5 to join. That's the way we like it. But if anyone's in a position where they want to support us with any larger donations, that would greatly be appreciated, because the reality is that we are still a long way from losing this overall battle and losing the war, as we call it, in the war room. So if Labor do win on their policies, that's terrific. Overall, if there is a change of government, good luck to them. But in terms of if you don't want any changes to occur, you know the team to vote for. And from my point of view, there's still a lot more water to go under the bridge. If we think about the policy was introduced in the past, so we've got the Senate to also help potentially block it. If it is eventually implemented, we also have it, we're a situation where it has been withdrawn as well. So from that point of view, there's still a lot of work to do here, and there's a lot of awareness to bring out to the community. So if you're like me and you want to see everyone's property prices not go down, then we need to keep the demand in the marketplace, because it does help renters, and it does even help owner-occupiers get in the market when there's lots of construction going on, because it adds to supply. And we've always been a believer that the best way you make things affordable is you increase the supply, you don't dampen the demand. So for those of you, again, who have joined me tonight or have joined me on the replay, please do what you can. That donation site will be live over the course of the next day or two, so stay tuned for that, and we'll be able to talk to you further there. Again, if you can find one other member to join us, that would be great. Help to continue building our strong voice for investors, encourage those investors to join the association to increase the numbers, and also make sure that we have influence on areas that matter. So it's not just what's happening in terms of federal politics, but there's also some rental reform policies that are rolling through different states and territories. Some are overdue, others are quite restrictive in terms of looking after the owners of the asset. So that's also something that we'll be picking up the fight on. But we need those numbers to be available to do that. And finally, just before I close out, I want to make a big thank you to all the people that made this possible. So Louise Pilkington, to also Nina here beside me, who's working very hard, to the team of people who volunteer and support us at the State Council level, and also the National Board. It's you guys who are making this possible. So we thank you for your time and effort and energy in terms of putting this together, and I look forward to seeing our